This exclusive tutorial will teach you everything you need to know about Forex trading. You want to learn Forex trading? Follow me as I put you through step by step. Welcome to Keys FX. Without further ado, let's get on to this video. Another technology that you also need to know is, of course, the pipet. So we have the pip, we have the pipet. Now, what is the pipet? Just like the opposite of the pip, we have the fifth decimal point. So the fifth decimal of the prices is what we call the pipet. That is the smallest price movement change is what we call the pipet. Now, this is of course has an exception of the Japanese yen, which is of course the JPY. Now, on the Japanese yen, the pip is actually the second decimal point, while the pipet is actually the third decimal point. So on the Japanese yen only, that is where we have this difference only. The Japanese yen, we have the second decimal point as the pip, and then the third decimal point as the pipet. But in every other currency pair that you have, the fifth decimal point is the pipet, while the fourth decimal point is the pip. Right, another technology that you need to know in the Forex market is, of course, the spread. Now, what is spread? The spread is different between the bid price, which is buying price, and the asking price, which of course is the selling price. Now, as you can see on this graphical representation here, we have the GBP USD. We have the GBP being quoted for 1.3089, and then the USD quoted for 1.3091. Now, if you want to get the spread right here, you minus 1.3089 from 1.3091. Now, when you minus that, you'll be getting 2 pips. So this is how you get your spread. So the difference between these two right here, which is these 2 pips, is actually the spread of the market. So the difference in the prices is known as the spread. Another key terminology that you need to know in the Forex market is, of course, known as the leverage. Now, what is leverage? Leverage is actually the capital that you borrow from your broker to enable you get a higher potential returns. That is, if you have like $500, your broker can give you up to $50,000, $1,000, $10,000, so you can be able to increase your potential profit in the market. Now, this is not just good in increasing your potential profit, it's also good in increasing your potential loss. So when using leverage, you want to be very, very careful so you will not get your account being blown. So the leverage is the capital you borrow from your broker so you can increase your potential profit in the market. Another key terminology that you need to know is, of course, known as the margin. Now, what is margin? As you can see on this graphical representation, is of course the amount of the leverage being given to you. The amount of the leverage that is being given to you is known as the margin. That is, when you have like $500 and then you want to control a position of about $10,000, that difference in between is what we call the margin. That's of course known as a leverage. So you are asking your broker to give you a leverage of XYZ amount, and then amount being given to you is of course known as the margin. So the difference between your actual capital and the amount you're borrowing is actually the margin. Another key terminology that you need to know in the Forex market is known as the lot size. Now, what are lot size? A lot size is the number of the currency units that you actually trade. Now, we have 4 major type of lot sizes. Number 1 is the standard lot size. We have the mini lot size, we have the micro lot size, and we have the mono lot size. These are rated individually different. Now, the standard lot size is rated from 100,000 units upwards and is represented with 1.00. And now the mini lot size is rated in the 10,000s, and then this is represented with 0.10 volume. And then the micro lot size is of course rated 1000s, and then this is of course represented with the 0.01 volume. And then the mono lot size, which is of course the hundreds, is represented with the 0.001 volume. Another key terminology that you need to know in the Forex market is called broker. Now, you must have heard me use the word broker. Now, what is broker? A broker is a financial intermediary that facilitates your buying and selling of currencies. This person acts as a middleman in between the trader and the foreign exchange market. Now, the broker does this to get a slight commission from the transaction in between the two. So now, as you can see on this graphical representation here, Here we have the trader, you the trader, and then the broker in between as the intermediary and then the first market institution where the trades are being transacted. So now, what does the broker do? The broker executes your trades on your behalf, offer the trading platform for you to use and the tools for you to use, provides the access to the market to you, and then in all of these, it charges you with a commission fee on those transactions. So that is just the job of the broker. So without the broker, you cannot trade in the forex market directly on your own. So the broker is needed for you to trade. So every trader in the market must have a broker that helps him or her execute the trade on behalf of them in the market. Another key terminology that you need to know in the first market is, of course, called the candlesticks. Now, what is candlesticks? The candlestick is a visual representation of the price movements of the pair in the first market. Now, using individual candlesticks to show you the open, the close, the high, and the low, helping traders to identify the trends and potential reversals of the market. Now, as you can see on this graphical representation here, these are the candlesticks. Now, we have the red candlesticks signifying the sell, and then the green candlestick signifying the buy. Now, this is the open of the candlesticks, and this is the close of the candlestick. This is the highest point of the price in the market, and this is the lowest point of the price in the market. So this is what the candlesticks represent. So it represents the price movement of the market, and then how the market has the potential to probably reverse or probably move further in the price movement. Another key terminology that you hear in the forex market again is what we call the bear market. Now, what is the bear market? Now, the bear market is a prolonged drop in the price of the pair in the market. Now, the prolonged drop in price of a particular pair in the market is called the bear market. Now, this graphical representation here represents what we mean by the bear market. So when the price is dropping and dropping and dropping, it is called the bear market. So this is one of the terminologies that you get to hear forex trader talk about. So the continuous drop in the price in the market is what we call the bear market. Another key terminology that you hear in the forex market again is called the bull market. Now, the bull market is the opposite of the bear market. Now, the bear market is a sliding down of the price, while the bull market this time around is the prolonged rise in the price of the pair in the market. So the prolonged rise of that particular pair in the market is what we call the bull market. So when you see the price rising, you have a lot of green candles coming in. That is, we are in the bull market. And we have a lot of red candles coming in. That is, we have the bear market. So this is what the bear market and the bull market terminology represents in the forex market. Having learned all these terminologies in the market, another thing you need to learn in the market is the type of traders in the market. Now, as a trader, you wanting to get into the forex market, you should know that we have 4 particular types of forex traders in the market. Number 1, we have the scalper, the day trader, the swing trader, and the position trader. These are the 4 types of traders we have in the market. So you have to know this type of trader in the market so that you can be able to know where to position yourself and what kind of trader you should be in the market. The scalper in the market is a kind of trader that focuses on small trades and capturing small micro movements of price in the market using the smaller time frame to do that. Like he uses the 1 minute time frame, the 5 minute time frame, or the 15 minutes time frame. So he's a kind of trader that captures just small movements, small micro movements in the market to make profits using the smaller time frame. So this is what a scalper is. What's a day trader? The day trader is a kind of trader that opens and closes his or her trade within a day. So when you open the trade, probably you open the trade in the morning and then you close the trade later in the day, in the evening, or probably the afternoon, or it took some hours, you are regarded as a day trader. So this is what day trader is in the market. What's a swing trader? A swing trader is a type of trader that holds trade for several days, capturing long moves in the market, capturing a medium move in the market. So this is what we call a swing trade. So you can open a trade today and closes it maybe in the next 5 days, or you open a trade today and closes in the next 1 week or so. This is what a swing trader is. Now, what's a position trader? A position trader is a kind of trader that holds trade for an extended period, often going from weeks to months and on and on and on. So you're holding your trade more than weeks, more than going to the months. You are a position trader. So you hold trades for such a long time, you're regarded as a position trader in the market. How does this type of traders, how do they work in total? What do they do in the market? Now, the forex trader basically analyzes the market and makes critical informed decisions in the market with using different types of analysis to determine the price movements in the market. So whether you're a scalper, whether you're a swing trader, whether you're a day trader, whether you're a position trader, what you do in the market is you observe the market, you analyze the market to make a critical decision in the market. So what they basically do is to analyze the market in three basic ways. So it's either you're analyzing the market as a technical analyst, or you're analyzing the market as a fundamental analyst, or you're analyzing the market as a sentimental analyst. So those are the three different type of analysis that goes on in the market. So whether you're a day trader, a swing trader, a position trader, or a scalper, you are analyzing the market, and you have three different types of ways that you can analyze the market. Either you're analyzing this as a technical analyst, or you're analyzing the fundamental analyst, or you're analyzing this as a sentimental analyst. Now, what is a technical analyst? Now, technical analyst is studying the movement of the charts, the chart patterns, try to predict the future trends of the market. While the fundamental analysis is you are evaluating economical and political events, social events to see how it affects the price. Sentimental analysis is you are looking at the market's psychology and where the price will probably go next. So these are just the three main different analysis that goes on in the market. So you have to choose in between the type of analysis that best suits you in the market. So either you're analyzing it as a technical analyst, or a fundamental analyst, or a sentimental analyst. So these are the three different type of analysis that you can do in the market. But all of these involves the charts and involves different data that you use to make your informed decision. If you watch this video to this time, please kindly smash the like button, turn on your notification bell, and of course subscribe to this channel so you can be getting more content from this channel. Until I see you again, keep making every pip count. Peace out.